Becoming financially successful is not an easy journey, to say the least. However, there are 8 key concepts that can help keep you on the right path. Fasten your seatbelts, folks. This is going to be a good one. Getting your financial ducks in a row is the key to building a successful financial future. We are talking a future where you are prepared for financial stresses, a world where you are receiving growing returns instead of paying compounded interest, a world of multiple income streams, diversification, and even a little emotional control. It is all about taking the right amount of risk to seed your retirement goals. Of course, if you listen carefully, I just told you 7 of the 8 pillars. Don't worry, we are going to look at each of them in a few minutes and dive a wee bit into how they all pull together. Join today's conversation. Let me know in the comments if you have your own version of the pillars. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. This one is definitely exciting, and even though it is aimed at new investors, there may be a few nuggets in here for the more seasoned folk as well. So without any further ado, let's do this. Your emergency fund is a major element of financial stability. It acts as a safety net to cover unexpected expenses, which can range from, well, a car repair to a loss of your job. We like to live our lives thinking it won't happen to us, but it does happen, and preparation can make it less of an impactor on our finances. It is generally advised to have 3 to 6 months worth of living expenses in a readily available form. Your emergency fund can still be making money for you. Some people like to hold it in a high interest savings account, which is not a huge return, but others will choose instead to hold it in a cash ETF, which can often net you closer to a 5% return. If you are using a cash ETF, you just need to be aware that it can take almost a week to access that cash. So in that case, as an emergency fund, you also want to have a credit card that you can use while you're waiting for the cash to clear. Of course, once that cash does clear, pay off that card so you don't incur any debt. A good emergency fund not only protects your finances when you need that protection the most, it can also bring peace of mind, as it is good knowing that you are going to be okay if, of course, the worst does happen. Debt management is a strategic approach to handling your debt, which can include everything from your mortgage to your credit cards or even lines of credit. The end goal of said strategy is to be lowering your debt with an eventual goal of becoming debt-free sometime in the future. The first part of a good debt strategy is to sort your debt into interest buckets, as all debt is not created equal. We have high interest debt and that much better low interest debt. Generally, your mortgage will fall into the low interest bucket, while credit cards tend to fall in that higher bucket. Once you have a good inventory of your debt, there are some ways to approach paying it off. One popular method is the snowball method, popularized by Dave Ramsey. With this method, you simply pay off your smallest debt first, regardless of, well, the interest on it. By doing it this way, you get a small shot in the arm for motivation as you watch the smaller debts disappear pretty quickly. Another method, which I hear is endorsed by Mr. Math, is the avalanche method. In this method, you are prioritizing your payments to the highest interest ones first. I personally like this method as it does allow you to overall pay less interest than the snowball method. Obviously, though, with both methods, you still want to meet the minimums on all of your debt sources to preserve, well, your credit rating. Another good tactic with debt is debt consolidation. For example, if you have a line of credit with an 8% interest rate, it would make sense to use it to pay off higher interest credit cards. Once again, this is coming down to the math and how you can get those interest payments lower each month, so more money is, well, going towards that principal and not into the bank's pocket as interest. High interest debt should be a higher priority than investing. It simply is not mathematically feasible to invest an extra $1,000 into an asset that may return 10% when it could be applied against a high interest debt compounding at 20% or, well, maybe even more. Having multiple streams of income enhances financial security and independence by diversifying income sources beyond your primary job. This can include passive income from, well, investing or maybe even renting a property, side hustles like YouTube, freelance work, or, well, even owning a business. Extra income streams can buffer you big time against economic downturns or job loss and accelerate the path towards financial goals. In fact, it can take some of the pressure off of your emergency fund if you were to lose your primary job. I won't lie to you and say that it's easy, because developing additional income streams is not easy, and people with a little bit of an entrepreneurial mindset can have an advantage for sure. The key is to find something you like or are good at and match it up with a way to market it. As a side note, it is said that typical millionaires have at least 7 streams of income. If you are investing, then you already have 1 extra stream of income. Diversification sort of falls under risk management, but it is important enough to get its own pillar. It is a risk management strategy that, in a nutshell, is all about creating a wide variety of assets within your investing portfolio. This is important because a portfolio put together with different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Diversification basically averages out risk, so if a particular asset fails, it is averaged up in the portfolio by a winner, which keeps you in the green while you wait for that underperformer to recover. A good diversification will reach across different asset classes like stocks, fixed income, crypto, cash, and of course real estate. In addition, within each asset class, there should be more diversification. So for example, within your stock portfolios, you want to spread your investments across multiple sectors. ETFs can be a great tool in helping you to achieve diversification and exposure to, well, foreign markets, which is of course another form of diversification. As good as diversification is, you do not have to go absolutely overboard. Trying to invest in every sector, every geographic region, a bunch of altcoins, can make it harder to manage. Stick to sectors you are comfortable with. If you are not sold on crypto, for example, don't invest in it. There are enough options out there to get a good diversification without having to spread yourself way too thin. In a nutshell, risk management is all about understanding the potential risks with your investments and looking at strategies you can use to keep those risks down to a level you are well comfortable with. The market is not a guarantee, and there are lots of fluctuations on a market scale as well as an individual asset scale. There can also be black swan events that are out of your control completely. Once again, that emergency fund can certainly look good when that black swan is honking. When you are looking at investments, being aware of their overall risk is important to know. If you are a very conservative investor, you are looking at the blue chip companies that you know can bounce back from the bigger market fluctuations. These stocks will absolutely provide you with more peace of mind. If you have a higher risk profile, then you may be more inclined to look outside of blue chip investing and dive into smaller market caps or take a more passive income approach with riskier covered call stocks or ETFs. Of course, if no amount of risk is too much for you, there are those penny stocks. One thing to keep in mind, risk tolerance will not be constant throughout your investing career. The risks a younger investor is willing to take may just scare the banana bread out of an older investor looking towards retirement. Typically, as we get older, our risk tolerance gets lower. One of the more important aspects of investing is your ability to manage your emotional control. An emotional investor will, without a doubt, make more mistakes than an investor who checked those emotions at the door. It's all about maintaining a steady course in the face of volatility and not allowing fear, greed, or other emotions to dictate financial actions. Emotional control is crucial for long-term financial success because those emotions can lead to impulsive decisions that undermine those very financial goals that you have set for yourself. When the market is booming, it is easy to get caught up in the fear of missing out or FOMO. This is that tendency to go all in on all-time highs. This can be a recipe for a huge future loss. A better way to invest when the market is booming is with dollar cost averaging. With DCA, if the market falls next week, you still have money to average down. On the other side, people will feel a general panic when markets are falling. They will feel fear, uncertainty, and doubt, or FUD, as we like to call it. This is that feeling like the stock is going to fall forever, and you just want to get out to save your money from going to zero. Unfortunately, when you do that, you turn an unrealized loss into a realized loss. And then, before you know it, the stock is going back up, and you were left in a hole that your FUD dug for you. Honestly, if you are not able to overcome your emotions, then you may not want to be doing your own investing. You may want to instead look at broad market ETFs, or even consider a robo or even a financial advisor to do the picking for you. One thing that does help with emotional control is to go into your investments with a plan. Dollar cost averaging is a fantastic way to approach buying, as it takes all the guesswork out of timing the market, and over time it will return a fair entry point, which tends to be more profitable than folks who try to time the market. To be a good investor, learning needs to be part of your overall plan. Understanding the way the market works and knowing how to do your due diligence on your potential stocks can literally save you from making a lot of bad choices. You will still make bad picks, but they will be less than the uneducated investor for sure. There are so many tools available for financial education, from books, free courses, YouTube, and even AI nowadays. There are lots of communities like this one and the much bigger one over there on Blossom that can assist you to move in the right direction. Improving your financial IQ makes it so much easier for you to make informed decisions, effectively manage your money, and ultimately lead you to financial independence. Finally, we come to retirement planning. This may be the most important pillar, as investing itself, even at a younger age, should have a focus towards retirement, even if it is just a passing thought for the very young investor. Starting early gives your investments more time to grow thanks to the power of compounding returns. However, it's never too late to start planning for retirement. Continuous planning and adjustments are vital, as your situations and goals, they're going to evolve over time. Overall, the essence of retirement planning is to ensure financial security and the ability to maintain a desired standard of living while also finding fulfillment in those post-work years. With retirement planning, one of your key abilities will be to have the foresight to see what resources you will have in retirement. Are you maxing out your TFSA? Have you deferred a lot of tax with your RRSP? Will you have a healthy CPP? Does it mathematically make sense to melt down your RRSP, take or delay CPP, delay OAS, or maybe even work longer into retirement? It all becomes a balancing act with many different numbers in the air, and the sooner you begin planning for it, the easier it will be to find that perfect retirement balance. Let's continue that learning journey. Check out this video on RRSP Meltdown, and I will see you in the next video.